Today, we are looking at a portfolio that is running hot. And I mean really hot. We're talking over 70% allocated to what we call rocket fuel, crypto, Tesla, Nvidia.
Right. It's the kind of portfolio that looks amazing during a bull run, but keeps you up at 3 a.m. when the wind changes direction. So today is about de-risking. We're taking a high-octane engine and adding some brakes, and maybe a seatbelt.
Exactly. We aren't killing the growth, we're just civilizing it. Let's start with the big one, the Bitcoin position.
Yeah, this is the first move. The goal here is reducing exposure without exiting the game. The strategy is to set a limit sell order for 50% of the Bitcoin position at $98,000.
Just shy of that psychological six-figure mark. Smart.
Exactly. The cost basis was around $94,000, so by selling half at $98, you lock in a profit, about $566 in cash. You pocket the win and you let the remaining half ride the wave. It's about discipline.
And speaking of discipline, we have to address the elephant in the room, or rather, the trap in the room.
The SDIV blunder.
Right, the Global X Super Dividend ETF. On the surface, the investor saw a small profit in USD terms, but this is what analysts call a currency illusion. It's actually a high-risk yield trap.
It's chasing dividends at the expense of capital. So what's the move?
Immediate exit, no hesitation. We're recommending a limit order at $24.10. Sell it, take the cash, and wipe the slate clean. We need to move that money into something that actually protects the portfolio.
Which brings us to the defensive growth asset. The investor specifically asked for a psychological safety mechanism, something to stop them from panic selling when the market dips.
Enter VIG, the Vanguard Dividend Appreciation ETF.
Why VIG? Why not just standard healthcare or consumer staples?
Because VIG isn't just safe, it's quality. It holds companies like Apple, Microsoft, Visa. These are companies that consistently raise their dividends. Historically, you're looking at a 12 to 13% annual return. It beats the boring defensive stuff, but gives you that emotional stability because you see those dividends hitting your account even when the market is red.
I like that. It's a fortress asset. So let's look at the new map. We're reshuffling the deck to fix that scary 70% risk exposure. What's the new target weighting?
We're breaking it down into 3 buckets. First, we dial back the rocket fuel, Bitcoin, Tesla, Nvidia. We're capping that at 50%.
That's a significant drop, but 50% is still plenty of upside.
Precisely. Then we have quality growth. This is Google, Netflix, reliable tech dominance. That gets 30%.
And the last 20%?
That's the fortress. That is your VIG and Discovery. That's your shock absorber.
Okay, so we have the plan, 50, 30, 20. Now execution. We just sold half that Bitcoin and generated about $566. Where does that cash go?
Clear, instructional. We split it. 60% goes straight into VIG to start building those fortress walls. The other 40% goes into Google to beef up that quality growth bucket.
Nice. So you're taking profit from the high-risk asset and feeding the stable assets.
Exactly. But none of this matters if you don't stick to the plan. We need to automate this so human emotion doesn't mess it up again.
This is my favorite part, the set and forget. We're using a hybrid system here.
Right. Step 1 is automated buying. You set up recurring investments, debit orders on your platform. You don't try to time the market. You just split your monthly contribution. 20% VIG, 30% Google, 50% rocket fuel.
Dollar cost averaging.
It eliminates the guesswork. But you can't just walk away forever. Step 2 is the quarterly tune-up.
Yes, this is manual, right?
Yes, once every 3 months, you log in, you look at your pie chart. If your rocket fuel has grown to, say, 60%, you trim it back. If VIG has fallen below 20%, you buy more.
Which forces you to do the one thing everyone struggles with, buying low and selling high.
Simple as that. You get the growth, but you sleep at night.
Sounds like a plan. Thanks for breaking it down, TechSlice.
Anytime. Stay balanced, everyone.